It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are back with more Managing Your Financial Future, and guess what, folks? It is a brand new season of shows. Professor Plum! Woohoo! It seemed like we just said season 6 was starting, and now we are 7 seasons. I don't really know how this whole season thing works.
Yeah, it used to be a season was like a year.
Well, on television, it used to. We may have even had this discussion before, but on television, it used to be a season started in September and went through like June, right? It was like your school year.
May, June, yeah.
Right, May, something like that, and then you took the summer off for all the rotten
shows. Then you started
shows.
all the reruns.
All the reruns, all the failed pilots, and then you would start the new season. So if you were in season 7 or 8 or 9, you were on for actually 7, 8, or 9 years.
Yeah, Gunsmoke was what, 22 seasons?
Something
22
like that.
years
Yeah.
or whatever it was?
Right. And now I see TV shows that are in, it's our 28th season, and they've been on for 12 years or something. So anyway, this is season 7 of our podcast, I'm told. First episode of season 7. I think we do 12 episodes per season.
And take a month off?
Well, we take about usually 2 weeks. I think we took a third week off this time. But we're back in studio, and I was just saying, I hope I remember how to do this. I know people listen to these things.
There's a lot of buttons you have to push over there to make this thing actually work.
Yeah, this is a self-engineered kind of a thing, you know. We don't hire engineers to do this stuff.
Why? We spend that money on what? We
Are you
need to
kidding
be
me?
more efficient, more frugal.
That's
we
right.
are financial advisors, and
We can't be wasting money on
No.
engineers.
Plus, between John and I, we're the cheapest 2 guys in
You
the
better
world.
believe it, pal. You better believe it. If you're going to pay an engineer, pay me, because I can do it myself. Although you kind of feel like a big shot when you're sitting in a studio and somebody else is handling all the work, you know? I don't know. But anyway, we're here back. A lot of great stuff, topics coming up. I've just got a preview here of what's going to be over the next few weeks. We'll be talking about next week, talking about investing in a 401k and how does it change as you approach retirement. You know, there are people who are in their 20s and 30s that probably should be investing one particular way, and they're not. And then there are those who are in their 50s and 60s who are approaching retirement and may have the wrong, you know.
And they may be treating their entire current portfolio of 401k assets and their ongoing contributions as the same thing,
which is
probably is not appropriate.
May not be. So we'll do that next week. Also coming up a little bit later on this month or whenever, talking about pensions. I know we've had the lump sum or annuity discussion before. How do you decide whether to take a lump sum? And if you do take the annuity, which option is best? I think we may have covered something like this a year or so ago.
Season 2.
Yeah, probably. But we have new folks joining us. And there are other aspects that we're going to get to, as well as tax management, keeping your tax bill low, or at least having the goal of keeping it low now and in retirement.
And low is a relative term.
Well, that's right. We don't talk so much about tax minimization as we talk more about tax management.
Yes.
And sometimes paying more
today
may, in some cases, give you an overall lower tax bill
over the next several years or the rest of your life,
which is called tax management, which is something that we do all the time. So what is today's topic? Well, if you've paid attention to the little blurb at the top of this program, you know that this has to do with Roth or traditional IRAs. There are 2 different types of tax treatments on these. Traditional IRA has been around for how long?
Since the 72, 73 time horizon, somewhere back in the early 70s.
Was it close to the ERISA thing of 74? Or it's been a while.
I don't think it came out because of that, but I think
it didn't. But
they were close, I think.
Yeah.
And at the beginning, I think they started in 72. I can't remember exactly. But I do remember that in the beginning, the states didn't all comply right up front. So you could get a federal tax deduction, but you didn't get a state tax deduction for states like California
Really?
and some others.
I did not know that.
That went on for about 4 or 5 years. So you had to keep track. If you didn't want to pay tax twice and you still lived in California, you had to keep track of your basis because you had an after-tax component for the state.
Wow.
What a pain that was.
That would have been a pain.
And then the federal government decided to say, well, some people can and cannot have that deduction. So now we have after-tax contributions to it from a federal, and we have basis to keep track of, and it's kind of our business to keep track of that.
Well, that's one of the things we're going to discuss here when we talk about whether you should consider a Roth or a traditional. The traditional's been around for 50 years, something like that, maybe not quite. Roths, on the other hand, are relatively new, although now, what was it,
24 years. 23 years.
98? 98.
1998 was the first year we could make a contribution or convert capital to a Roth IRA.
Yeah, so while Roths, I still tend to look at those as new, they're really not. I mean, a couple decades old. They've been around for a while. So the question in some people's minds is, how do I decide between doing a traditional IRA and a Roth IRA? Let's compare the two, first of all, Professor Plum, a traditional IRA versus a Roth. Let's talk, first of all, about
well, first of all, they are retirement savings accounts. And with retirement savings accounts, we have some form of tax favor. Something to entice us to use it. The whole idea of an IRA, whether it be traditional or Roth, is it's an account to save money in. But we have accounts to save money in. We've always had the ability to save money. But a lot of people don't do it without some form of incentive. So the first thing they did was they gave us a tax incentive to make a contribution, the traditional IRA.
Traditional IRA.
So they said, if you put this money in, we'll let you not pay taxes on it today. So the original limit was $2,000. You could put $2,000 in and reduce your income tax bill or your taxable income by $2,000 in whatever tax. If you were in a 40% tax bracket in those days, that would save you $800 in taxes. A nice little incentive to save for your own good. I mean, the whole idea is you're saving for your own good.
Yeah, and about this time, I think the traditional pension plans were kind of they were still there, but they were starting to phase out. Yeah,
but it goes back to even when the traditional pension plans were there, you were supposed to have three sources of income in retirement: Social Security, your pension, and personal savings. And so those were the three sources. But
much like now,
yeah, except for we don't have pensions in a lot of cases.
Yeah,
so we have two main sources: Social Security and your own personal savings. So but the IRAs were there, and they were first giving you a tax incentive to save the money. And then you would pay taxes on it when you withdrew the money 100 years later, when you retired. Now, when they first did this in 1972, 1973, 4, 5, it didn't have any impact on your Social Security because Social Security had no taxation at that time.
Right.
Social Security was not an issue. It wasn't until 83 that having taxable income in retirement could potentially screw up your Social Security.
And we'll get to that. But the traditional IRA
has 3 parts of it. The contribution, the money going in, tax deductible for many people, not tax deductible for some now. But originally it was tax deductible for everybody.
Everybody who had income of some kind.
Well, to be able to contribute, you had to have income. You earned income. Yeah. Income, basically, you were paying FICA or Social Security taxes on.
Yes.
And so if you had earned income, you could contribute up to the $2,000 mark. Up now the limit is $6,000 plus an extra $1,000 if you're 50 or older. And it's still, you have to have earned income. But if you have it and you are eligible, you can put the money in on a pre-tax basis and get a tax deduction for putting the money into the account.
That's traditional
part
side.
One.
Yes.
Part two is the seasoning period, the accumulation period, the deferral period, the time between when you make the contribution and when you retire and start taking money out. There's no taxation on that middle step. So you make the contribution, tax deductible. You let it grow, no taxes. No matter what it earns, interest, dividends, capital gains, whatever.
Buy, sell, whatever within the IRA.
With very little exception.
Yeah.
There is no income tax while you're waiting. And then once you're 59 and a half or older, when you pull the money out, then you get to pay the taxes. Tax deductible going in, tax deferred middle section, taxable at the end.
A Roth, on the other hand, is somewhat the opposite.
Somewhat. Flip it around. There is no tax deduction going in. It's still tax deferred in the middle. And if you live up to the rules, the money coming out, regardless of how that money's coming out, whether it's principal, converted IRA money, or earnings, it'll be tax free if you live up to the rules. And so it's basically the exact opposite of a traditional IRA. And so when it comes time to try to decide today, you're working, you're trying to figure out what you're going to do, you want to save something for retirement, or you at least feel that you need to save. You may not want to do it, but you feel that you need to do it. You have options. And as an individual that's working, has earned income, we have the traditional IRA and we have the Roth IRA. Which one should you be using? And so that's a big question we get from a lot of people.
Yeah.
Should I be doing traditional and getting the tax deduction today, or Roth IRA and getting the tax-free income in retirement?
I mean, is that the question? I guess it is. If you can come up with an answer to the question, do I need the tax deduction now, or is it more important later on for me not to pay taxes on it?
Right, and that's looking into the future is a hard part because we don't know what the tax code is going to actually look like.
Yeah.
But we know what the tax code looks like today. And the immediate gratification of a tax deduction, sometimes will win out over the, I have no idea what my income tax is going to be in the future, and I'll deal with it then.
What I've heard, of course, is that if you're in a low tax bracket today,
yes,
it might be better for you to not take the deduction because you're not paying that much in tax anyway, and you could potentially be in a higher tax bracket later on. So the Roth would work better if you're in a lower bracket today. If you're in a really high bracket today, the tax deduction is obviously worth more if you put the money in. Does that still hold true?
Yes, I do believe it. And the reality is, if you are in a low bracket today and you can project into the future and say, I'm going to be in a higher bracket in retirement, the Roth is a better deal than the tax deductible traditional IRA. On the other side, that's not the majority of people out there in the reality. The majority of people, especially when you have a double income family, a dual income family, where your income is fairly high today and in retirement because people don't save enough for retirement and there aren't as many pensions. And these are all factors that come into play. In retirement, we're looking at income coming out and it'll be potentially in a lower bracket in retirement. That means that what's more valuable to you? The tax deduction today and then paying some tax in the future, or vice versa. High bracket today, high income today, low income later, traditional IRA, if you can get the tax deduction. Now, on the other side, if you're in a lower bracket today, or even what I would consider to be the same, if you think it's going to be a push or a very similar tax bracket treatment today as in the future, I opt for the Roth IRA. There's some other reasons. So if you knew for a fact that you were in the same, you're putting it in today and you're in the 22% bracket, and when you take it out in retirement, it's going to be the 22% income tax bracket. I'm going to take the Roth in that case because that tax-free income in retirement has the ability to affect other areas that can screw you up too, and in a positive way, not a negative way. So it may be 22% both sides, so I'm kind of not saving anything, but am I going to be paying tax on my Social Security benefit because of that distribution? Of course, in the 22% bracket, I probably max that out. On the other side, will I be subject to IRMA, the income-related monthly adjustment amount for Medicare premiums? The Roth IRA doesn't affect that. So even though the tax brackets are the same, there's other additional taxes that may be created by taking that taxable distribution from the traditional IRA.
So you're saying...
And the required minimum distributions can be a giant pain too.
Well, see, and that's the thing. See, just on the face of it, what you said was more people tend to be in a higher bracket while they're working and a lower bracket in retirement, right?
From a pure income standpoint, that's pretty much true.
Right.
Unless you have these wonderful pensions that, like first responders, fire, law enforcement, things.
Sure.
Like that. Some government employees, they've got decent pensions.
So that would tend on the face of it, that would tend to say, well, the Roth wouldn't make as much sense as the traditional if you're just going on the tax bracket now versus tax bracket later. But the Roth, as you're kind of saying here, carries with it some additional benefits. Having Roth income in retirement,
having access to tax-free money can be a blessing. I mean, especially you're in retirement and you need a new car. Or you just need to repair your own car. You need $5,000, $20,000, $50,000, whatever the number is. It depends on what kind of car you have. You're thinking, man, if I take it out of my IRA at this point, to get 10, I got to take 15. Whereas if it's in a Roth,
because you got to pay taxes on it,
right? Because I got to pay tax on it. But and I happen to live in a state with a state income tax, so I always gross it up a little more than for somebody who's listening. And how do you get to 33%?
Right.
Well, live in California, and. So it's coming out of the Roth. If I need 10 grand and I'm over 59 and a half, it's been 5 years of my Roth, I can just take 10. And it doesn't affect my tax on my Social Security. and it doesn't affect whether I'm going to be an IRMA, and.
Well, when you take money from a Roth, I mean, does it even appear on your tax return anywhere?
Currently, if you're taking what's known as a qualified distribution, meaning the custodian knows you've had it for at least 5 years and knows you're at least 59 and a half, it shouldn't even show up on your tax return. That's a good thing.
It's a good thing for purposes of Social Security taxation, for purposes of
there's other phase outs of other things too.
Yeah, we don't have to get into those. But so even if you're in a higher bracket,
I would say it depends on how much higher you are today versus in the future. And that's the problem, because it's very hard to project in the future. We currently know what our brackets are. We got 12, 22, 24, and up the line. In a couple of years, they're set to sunset, or they're going to sunset.
Go back up.
And go back up to the 15, 25, 28, unless Congress at that time, or even between that, changes it. And who knows what's going to happen. So we're looking at today's brackets. We can't just project today's forever. So we have to make some assumptions and what's going on. Now, the other thing is, if you're in a high bracket today where that tax deduction may make sense, you may not be eligible for a tax-deductible traditional IRA.
Talk about that.
Basically takes the question right off the table.
Because there is an income limit.
If you are part of a retirement plan at work, if where you work, and whether you're self-employed or work for somebody else, if they offer any kind of retirement plan, a 401k, a pension, deferred comp, any of these different types of retirement plans, then and your income is over certain adjusted gross income levels, you become ineligible to deduct all or a portion or even any of that traditional IRA contribution. For a married couple, if your adjusted gross income goes over $198,000, you lose the ability to deduct some of that contribution.
That's for this year.
That's for this year. It goes up a little each year. And if you go over $208,000 of adjusted gross income, that's on the front side of the page, before your deductions, then you lose the ability to deduct any of the traditional IRA contribution. For a single individual, it's $125 to $140.
That sounds like the Roth income limits too.
The Roth income limits, the ability to contribute directly to a Roth income limit is the same limit.
Okay, so but now what you're talking about, let's be clear here. What you just said was that if I work for a company that offers a 401k and I'm participating in it, right? I have to be participating.
Either you or the company. So if the company's making any contributions to it,
then I consider that to be in that category. If I have any money of mine going into my company's retirement plan, I'm a participant, then I am subject to
these rules,
these income limitations.
If any money from the company goes into an account for you, pension plan, any kind of profit sharing plan, it doesn't have to be your money going in.
Yeah, it can be the company's money.
It just has to be money going in on your behalf.
Yeah.
And then you are subject to these phase-out rules for the traditional IRA deductibility.
I could still contribute.
There is no limit on income for the ability to contribute to a traditional IRA. The contribution, and now we don't even have an age limit on that. Yeah. We used to have an age limit, but now it's anybody who has earned income can contribute to a traditional IRA. The question is, can they deduct that contribution?
Now, if all my company has is a 401k and I'm not participating in
and
it,
or
there is no,
if there's no company plan, or they offer a plan but you're not taking advantage of it, and they're not putting any money in for you. See, that's where it catches some people. The company may be putting some money in and you don't even know it.
Yeah,
and that's where on the W-2 it's got a little box that says retirement plan check, and so if you say that you're eligible for a deductible traditional IRA, but your W-2 says otherwise, expect a nasty gram from the IRS.
If you make
the contribution and try to deduct it.
If you make it and your income
over
is over those limits, yeah.
So, but you're listening. If you're listening, you're hearing a little bit of a problem. If I go over 198 to 208,000 as a married couple, I can't deduct the contribution going into an IRA. But then if I go over 188 to 208, I can't make a contribution at all to a Roth IRA.
That's exactly why I brought that up.
There are limits to who can contribute to a Roth IRA. There's no limits on who can contribute to a traditional IRA. That's the deductibility. But there are actual limits on who can contribute the money to a Roth IRA. So now we got to figure out, okay, am I in a higher bracket today or higher bracket in the retirement? Am I eligible for this? You just got to work your way through the issues. Now, if you do not have any IRAs, you can do Roth IRAs kind of. Let's say you make $300,000 a year.
That's well over the married or single. You're well over the
That's
limit.
why I picked that number. No haggling here.
Yes.
And you're self-employed and you don't have any kind of retirement plan. Well, if you make that kind of money and you're self-employed, you should have a retirement plan. Come and see us.
Mm-hmm.
But for whatever reason, you forgot to set it up, and now you want to make a contribution. You have no other IRAs. You have earned income. You can contribute, and for whatever reason, you want the Roth. You can, because you've already built a 401k from a previous company or what. I don't know why. You can do a backdoor Roth IRA.
Now, you said you're self-employed. You have to be self-employed for this.
No, you can be an employee.
Okay, so it doesn't matter. You make $300,000.
The key is, you have a retirement plan. Maybe you're already maxing out your 401k,
Mm-hmm.
and you want to do a Roth IRA, but your income is way too high to do a Roth IRA. But you've got this big $1 million $10,000 401k, $5 million. You have a 401k
Right.
with money in it that you're participating in. How do you do a Roth IRA when you're over the limit? Well, you contribute to an IRA, non-deductible,
Traditional, non-deductible because you make too much money.
and then however long you want to wait, you convert it to a Roth IRA. So that way, I'm not a big fan of the non-deductible traditional IRA just for the sake of the non-deductible traditional IRA.
Yeah.
It screws up things in the future. It's just a hassle because if I'm contributing, non-deductible money to my IRA, so I've been doing that $7,000 a year, non-deductible. I build up, couple $100,000 over the years, of which 60 of it is my after-tax money. But I also had my 401k, and I rolled it over, and now my IRA, my combined IRA between the 401k and my IRAs that I've been building up over the years, $1 million. Nice little retirement nest egg. I want to take money out of my IRA. I've been very careful. My non-deductible IRAs are over here at XYZ, and I rolled my 401k over to ABC brokerage. So they're very separate. I know exactly, of that $100,000 at XYZ, 60 of it is my after-tax money. So if I take out $10,000, I'm thinking I should be able to get to my 60 at some point. But even if I pro-rata it, that's 60 out of 100. That's 60% of the money I'm taking is after-tax money. That sounds good. Sorry, folks. Doesn't work that way. The IRS doesn't see accounts. They see value. And they see the value of your IRAs, all aggregated together, is $1 million. And the aggregate total basis in your IRA is $60,000, as in this example. So 60 out of $1 million is 6%. So every distribution I take, if I take $10,000 out,
It'd be 6%.
$600 is not taxable.
The rest.
The other $9,400 is taxable. Now I got to keep track of that. Okay, my basis was $60,000. Now I just take out $600. So now I have
It's a headache.
$59,400, and I have to file the tax return every year, a separate form
8606.
to justify
Yeah.
or pay tax twice.
So
So which one do you do?
which traditional or Roth? And obviously there are complications. There are things that you need to consider. It's almost like a flow chart. If this, then that, right?
Yeah. To some degree, it's very much that way. But we also have to, can you deduct it? Should you deduct it?
So you what you would do is you would say, okay, well, here's the deal. First, you might ask, am I in a higher tax bracket today than I will be in retirement? Should that be the first question you ask?
Well, yeah. How much am I making today?
Mm-hmm.
What is my expected income going to look like in retirement? To give us an idea of what the expected taxation is going to be in each situation.
And what are the sources of the income?
Yeah, where's the income coming from?
Yeah.
How much of that is going to affect my Social Security? Other issues.
So that's sort of the first question, tax bracket today versus tax bracket
now
later.
the question is, what options do I have?
So if I think that my tax bracket is higher today than it will be in retirement.
I'm going to opt, most likely, I'm leaning towards the traditional IRA deductibility.
But now I've got to look at the traditional. Can I even deduct a
traditional IRA?
And if the answer is no,
then how can I get a Roth?
Then we go back to the whole, which we've talked about. I may not be able to
do the backdoor Roth. And I had a friend once tell me that she was doing her 401k, she was doing her Roth IRA, and she's like, the government won't let me save anymore. I'm like, government's not stopping you from saving. They're just not incentivizing you to save anymore. You can always save more in a personal brokerage, and do it. And in some cases, it makes sense to do so. I've done my 401k, I've done my Roth IRA. Having a third source of income that is different taxation. It's not fully taxable like a traditional IRA distribution. It's not completely tax-free like a Roth IRA distribution, but it may be giving me long-term capital gains, which for a lot of people in retirement are in a 0% income tax bracket, although it still could affect your Social Security taxability. But it may have principal that I can take out. So having the three different types of accounts can be very advantageous and offers a lot of flexibility in retirement.
Yeah, we talk about this in our Social Security webinar from time to time. Talk about having traditional, we have a brokerage account and all that stuff, and maybe some Roth. We don't bring up Roth too much when we do the webinar, but just to kind of wrap this in a neat little package. How my tax bracket now versus tax bracket later. If I'm leaning toward traditional IRA,
can I deduct it?
Can I deduct it? If I can't deduct it, is there a way I could potentially get money into a Roth IRA through what's called a backdoor Roth?
Right. If I need to save the money.
Right.
I want some form of tax incentive. Getting a deduction today might be better, but it's not available. Getting a tax advantage in the future is better than nothing. How can I get one or the other? And if not, I'll just save personally.
And if I think that my tax bracket today is going to be
same or lower,
or no, my tax bracket today is the same or lower, yes, then it will be in retirement. Then I need to look at the Roth.
Right. And I lean towards the Roth a lot. And people talk about age. The younger you are, the more likely Roth is a better choice. For two reasons. One, capital appreciation that can be tax-free, and the deduction is fairly small at the beginning. And two, you're not in the higher tax brackets. So
generally.
And if you're starting to save when you're younger, that means you're probably going to have a nice nest egg at some point in the future and probably have a tax issue. So the younger you are, but that doesn't mean that older, I was going to say old people, the problem is one of them now.
We're there.
It doesn't mean that the Roth IRAs are bad for older individuals. It just means that, like many things, youth is better.
Youth is better not in every way.
No, not in every way. But
not in every way.
But I've talked to people about contributing to Roth IRAs in their 60s, and they're saying, I thought they were only for young people. Well, it's not that they're only for young people. Yeah, there's an advantage to the young having more time to let it grow, but it doesn't mean that it's not advantageous to the 60, 65-year-old to do a Roth contribution instead of a traditional IRA if the numbers work out right.
How does that help somebody who doesn't have nearly as much time? Statistically, a 65-year-old doesn't have nearly as much time as a 25-year-old to allow that tax-free.
Because they're in a lower bracket today than they might be in retirement. I've seen people who have been very diligent in saving, and they've got very good IRAs. And while their income is going to be in that 12% bracket today, married couple, they're going to have less than 100. They have $100,000 of income today, and they're going to have $100,000 in retirement. They've been able to work it out because they've saved so well. That income bracket, even though it says 12% on the sheet that says if my income is under X, there's a bigger issue going on in some cases, because when I get into a certain area of income, for every dollar I take out of the traditional IRA, maybe my Social Security is $40,000 and I'm taking $60 from the IRA. Well, that's going to have a big impact on the taxability of my Social Security. So in effect, for every dollar I'm taking out of the IRA, I'm paying a tax on 85 cents of a Social Security benefit I wasn't. So yes, it's 12%, but instead of being 12% on a dollar, it's 12% on $1.85.
Which is considerably more,
right?
Or at least it's more.
It's like 22%, by the way.
Yeah, sure.
On the other side, if I'm taking it from a Roth, I could have gotten a 12% tax deduction up front, but I didn't. Now I'm going to take it out and avoid the 12% tax and avoid the tax on the Social Security benefit. So I'm not in the same bracket. Even though it's 12-12, on the table, I'm in a better situation.
It's about looking ahead.
It's a lot about looking ahead, and unfortunately, there are some assumptions that have to be made.
Well, there are, and you know who knows about these assumptions? Professor Plum.
And the Lucia Capital Group.
The advisors whom you help oversee on all the financial plans that go out at Lucia Capital Group. I want to bring that up. I'm going to mention that here because obviously this decision of Roth versus traditional, while it seems basic, tax bracket now versus tax bracket later, you've just spent the last several minutes talking about how it's not so basic.
Right.
What might seem right now may not be the right thing to do 10 years from now.
Right. And it's not just people in the 50, 60, 70, people at the $150,000 to $200,000 level have issues too. They may they're in the 22% bracket and they're saying, I really like that deduction. And in retirement, I'm going to be in the 22% bracket again. And at that rate, it's not going to affect the taxability of my Social Security. I've already maxed that out.
Yeah. So,
which
is what happens.
Oh,
Sure.
At some point, you hit the max on the taxability of Social Security.
And there's nothing you can do about it.
But if I can find a way to keep my adjusted gross income, my modified adjusted gross income, under a certain threshold in retirement, if I'm in that higher number, $170,000, $180,000, then I can avoid a surtax on my Medicare premium. IRMA.
Income-related monthly adjustment amount.
Right. And so if I can then blend my incomes between traditional IRA distributions, Social Security, maybe some pensions, and Roth IRA, I can avoid a jump in my Medicare premium.
You get all excited talking about this stuff. The potential, the potential of saving some money tax-wise or otherwise, or maybe perhaps having more money to spend in retirement. That's the whole point of financial planning.
Financial planning has multi-layers to it. One is making sure you have sufficient cash flow, your risk return, making sure you're not taking undue risk to get the same returns, or but tax planning is the next level, tax management, and I like it. It's fun because I don't like paying taxes personally.
No,
and the more I can be efficient with my money, the more I can help you be efficient with your money. Taxes to me are an expense, and they're an expense that I don't mind reducing if I can. And
because some expenses I don't mind because I get something in return for them.
Right, direct.
You get it right. You don't get anything in return for these federal taxes. So this is why we talk about things like this. And folks, this is why it's important that you talk to, I believe it's important you talk to someone like Professor Plum or any of the Lucia Capital Group advisors, because they do this stuff all the time. Professor Plum talks about this stuff.
In his sleep, probably. I don't know.
All the time. Well, we were just down the hall, an hour or so ago, and you were talking to somebody else about this on the phone. This is what they do. If you want to talk more about your tax situation, do you need to decide whether you should do a Roth or traditional IRA? Maybe the decision isn't that clear cut. Give them a call. 800-644-1150. The number at Lucia Capital Group, 800-644-1150. The advisors can help you out.
And we're going to expand on this discussion in next week's podcast, because we're going to add another layer of complexity to the decision when you add in the ability to contribute to 401k.
401k, what a segue. How come you're not doing the hosting now? Where did you learn all
this? Because you need
a
job. I don't want to have to see you on the homeless aisle.
Where did you learn to be a podcast host? That is phenomenal. I thought I learned a lot from hanging out with you regarding financial planning, but now you're picking. Yeah, I have, but you're picking up on all the media stuff.
Trying.
That's not bad. I'm impressed. The number 800-644-1150. You can also go to luciacap.com, LUCIACAP.com, and don't forget to subscribe at Spotify. You can listen to our podcast, download them at your leisure or possibly leisure, depending on what part of the country you're from. You can listen to us, find the topics that you like, get rid of the ones that you don't like. Just check us out, subscribe to us, Managing Your Financial Future. That's the name of the program there, and you can do so at Spotify. That's what we do. We work very hard to manage your financial future, and we hope we do so successfully. Out of time. We will be talking next week about 401k. Don't miss that. For Professor Plum, certified financial planner professional, I'm your podcast host. I'm not an advisor, but I love hanging out with guys like this. I'm Johnny Dean. Thanks so much for talking to us. Thanks so much for listening to us, and we'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and/or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.